Okay, everybody. Thanks for joining us today. This is Tim Travis. It's April 8th, 2025, and I've had a few technical problems, so I've recorded this a couple times already, so let's hope that this time it works out okay. I'm not the best sometimes with Zoom. But anyways, let's talk today about all of the volatility that we're seeing related to tariffs, kind of the stock market, bubble popping. There's a lot going on. So, firstly, uh, disclosure. So, investing in the financial markets involves the risk of loss. Options are not suitable for all investors, and past performance is not indicative of future results. So, how do we invest? We look for undervalued stocks and bonds. So, we're value investors. These types of value stocks, they offer less risk and potentially better returns than the overall market over the long term. And in addition to that, we use different tactics. So we use option strategies such as covered calls and cash secured puts. The commonality is that these strategies are used to generate income and reduce risk. And we don't do any speculation. So we don't do any buying of options. We're not looking to gamble at all. We're focused on minimizing permanent losses of capital. And so here's a quote from Seth Klarman. He says, "Uncertainty is not the same as risk. Indeed, when there's great uncertainty, such as in the fall of 2008, it drives security prices to especially low levels, so they often become less risky investments." All right. So that's a great quote. And if we did a poll earlier in the year when the market had just had two massive years of performance, I would venture to guess that most people would be thinking, hey, there's not that much risk. And you can see that because people were very long equities. And now we've seen 20% drawdown in the markets and people are scared. There's a lot of fear out there. And you see it because people are panic selling. So it's a wonderful quote and there's opportunity. Looking at market valuation. So the Schiller inflation adjusted PE is still 31. So that's still 15.4% higher than the recent 20-year average. And that 20-year average is a lot higher than the previous 20-year average. So take it for what it's will, but overall the market's expensive still. Not as expensive though. That number was probably 38 or 39. We did a presentation, I believe, in January, and I think it was 38 or 39. The regular PE stands at 24.2, which is 46.7% higher than the historical average. The 10-year treasury has been, it was down below 4% like a day and a half ago, and now it's at, 4.23, 4.3% roughly. Junk bond yields, spreads have widened, so that's a good indicator of risk. And so the yield's at 8.65% now, so that's getting more attractive actually. The S&P 500 year to date is down 15.3%. The Nasdaq's down 18.45%. And even after the incredible year last year, over the last 1 year period, both the S&P and the Nasdaq are down mid-single digits. So that's the lay of the land. And here's a quote from my favorite, one of my favorite Renaissance political leaders, let's say. It's a common fault not to anticipate storms when the sea is calm. So when stocks are doing well, when the headlines are euphoric or just good, when there's not a lot of risk out there, a lot of people get comfortable and they start taking on a little more risk because they just see the upside and they don't see the downside. And so it's during those periods and all periods really where you have to be preparing for the potential storms, the inevitable storms that come. And that's where working with a financial advisor like us and someone that can really focus on risk management is critical. So how do we set you up for success? So at TNT Capital Management, every investment is handpicked and thoroughly researched based on deep value principles. We build focused portfolios based on maximizing risk-adjusted returns as opposed to the overly diversified approach others take. So one of my things that I do is I host a radio show. It's called The Truth About Money with my partner, Bruce Weinstein. And part of that show is we get callers and callers send us their portfolios to review. And so we see it from Edward Jones, from Morgan Stanley, from Merrill Lynch. And what we see a lot of lately is a lot of mutual funds, so very overly diversified, a lot of like similar strategy mutual funds, but multiple different layers, Those funds have fees on top of the investment advisory fees, and then very little like individual stocks, almost no individual bonds, and almost never covered calls, cash secured puts. So cookie cutter vanilla, that's where our niche is. Okay. So the reason I started this firm was because I wanted to manage money for other people the way that people like Warren Buffett do for themselves, and the way that I do for myself. I wanted to offer you the best product, the best service I can. And I think you need all the tools in your toolkit to really do that. So we utilize those tactical strategies, the covered calls, the cash secured puts, that can potentially generate good results in poor markets or flat markets. And I've been writing about the fact that, the last 15 years have been so good for stocks. The starting out valuation now is so high that it's very difficult to envision stocks doing well over the next decade, anything close to that. So here's the concept of margin of safety. Okay. So this is Benjamin Graham's concept. And basically, a stock is a fractional share of a business. Every business or stock has an intrinsic value. The intrinsic value of a business generally changes at a much slower rate than the price of a publicly traded stock can change. Over time, the intrinsic value of a business and the stock market value of a business converge. It could take 90 days, it could take 3 years. But by buying the business at a substantial discount to intrinsic value, you are thereby creating an adequate margin of safety. And so, one quote from Buffett, he says, "A year in which we decline 15% and the Dow declined 30% would be much superior to a year than both we and the average advanced 20%. Over periods of time, there are going to be good and bad years. There's nothing to be gained by getting enthused or depressed about the sequence in which they occur." So, think about the years going up to your retirement. Think about being retired or any time, really. I mean, if you can lose a lot less than the market and not have to make up so much, that's going to really put you a step ahead. And, in those golden years, those red zone years close to retirement, it's critical that, you're protected and you're not taking huge permanent losses of capital. So I just played pickleball with my wife, so I'm a little sweaty right now. So I apologize for that. But wanted to get some exercise before it got dark out. But so wise words once again from Buffett. So options. So according to the Chicago Mercantile Exchange, the majority of options held to expiration expired worthless. So about 3/4 over time. And so it's kind of like being the casino, the house. We don't want to be the sucker at the roulette table. And so we use options as a tool to add that element of timing, which you don't have when we're just buying stocks. We use them for the purposes of generating income, reducing risk, lowering our cost basis, and selling at prices that we are comfortable selling at, not speculation. All right, first stock, Alexandria Realty, ticker symbol ARE. Stock's at 76.94. It's about 41% below its 52-week high. A couple years ago, this was over $200 stock. They own biotech offices, high-tech scientific offices, primarily located in the dominant areas such as Massachusetts by MIT and Harvard, San Diego, Silicon Valley. Really healthy company, great balance sheet, conservative dividend payout ratio, long-term leases. So the dividend yield's 6.8%. That's like the highest I've ever seen it. The stock hasn't been this cheap since the financial crisis. And so ARE trades at only 10 times free cash flow, which is AFFO. And historically, they've traded in the high teens to low 20s. So if the stock trades at just 15 AFFO of 763 per share, which is the estimate for this year, the price would be $114. So that's nearly 50% higher than the current price. Plus, you get that dividend. So fantastic stock, really undervalued. I mean, this thing was like 100, maybe like 3 weeks ago. So really attractive opportunity. So another way we can play it is covered call. So you buy 100 shares at 76.94. You sell one October 2025 $100 call for $1.50 per share, $150 per contract. The maximum risk is 7,544. And when you think about options on covered calls or cash secured puts, think of it as a flip of a coin, heads or tails. So heads, if ARE expires above 100 in 192 days, you'll collect the full target profit of $2,306, so upside to 100, or 30.56% on the maximum risk. Plus, you get the 150 from the calls, plus another $260 from the dividend. for a total of $2,720 or 36%. This equates to 64% annualized. So fantastic returns. And as I said, the stock was at 100 a few weeks ago, and nothing fundamentally has changed for the business. Tails, right? If ARE expires below 100, you're going to own 100 shares at a break even of 75.44, and you'll have all the upside or downside from there. So the stock could drop about 2%. Look, if you wanted to make it safer, we could sell the call closer to the money, like 85, 90, even 80 if you wanted to, and you'll get a way lower break even price. But because the stock's so undervalued, we want to do it at 100 for this example. And you'll also get that $2.64 cents of dividends. That's just 2 quarters of dividend payments, by the way. So that lowers your break even to 72.8, so 5.4% lower. But you'll just keep collecting dividends. We expect that dividend to grow. So we love this opportunity. Next opportunity, Blue Owl Development Company. So this is a business development company. They're a subsidiary of Blue Owl, which is a large alternative asset manager. And the stock has traded down to 1256, right around its 52-week low, like much of the market, 26% below its 52-week high. The dividend yield is 11.78%. So they pay out 1.48 per share, and they do pay supplementary dividends above that sometimes. So could be beyond that. And this is basically a collection of loans. So loans on larger private companies, some publicly traded companies, but it's a big loan portfolio. And so normally it trades kind of close to book value. And the book value as of 12/31 was 15.26. So the stock currently trades at 82.3% of book value. So very cheap stock. Now, if the stock goes back to book value, that would equate to a return of 21.5% of just upside. Plus, you'd collect the 11.78% dividend. So a total return of about 33%. So really attractive, nice returns. The dividend, it can fluctuate, but book value, could it decline? Yeah. Like if they have a lot of loan losses, it could. But here's another thing. So like, let's say that it declines slightly. I don't think it would decline a lot. And management says, well, I mean, look, if we can buy our stock at 80% of book value, we're going to do that. And that by doing that, that's going to increase your book value per share. So there's a lot of ways to win. Now think about OBDC kind of in like a retirement portfolio where the incomes, you're not paying tax on that until you actually take your RMDs or a Roth where you've already paid the taxes. I mean, this is the type of thing you want to own. If you're looking for income in retirement, what a great solution. Citigroup. Okay, we have done so much with Citigroup over the years. And what we do is we buy it when it's incredibly cheap at a large discount to tangible book value. And we sell it when it converges towards tangible book value. Now, if they ever really improve the business sustainably, maybe it'll trade at multiples of tangible book value like some of the other banks, but they're just not there yet, and you don't need to do that. So we've made a ton of money on it, and we recently took a lot of profits, kind of at an average cost, I'd say, in the 70s. We traded up into the 80s, so we kind of looked, oh man, we sold too early. But now here we are. You get a big correction in the market, and the banks always seem to catch, the flu when the market catches a cold. So stocks back down to 58.14. So fortunately, we had sold a lot of it. Now we have a chance to reload. So what we can do is we can sell one January 2026 $50 put for $4.90 a share, $490 total. The maximum risk is $4,510. So once again, heads or tails? Heads. If Citi expires above 50 in 283 days, you're going to collect the full target profit of $490 or 10.86% on the maximum risk. So this equates to 14% annualized. Very, very attractive return. And here's what I like about it. Okay, so tails. What's the worst case? Well, if Citi expires below 50, you're going to own 100 shares at a break even of 45.10, and you're going to have all the upside or downside from there. Therefore, the stock could drop by 22.42% by expiration before you lose a penny. Now, keep in mind, Citigroup was trading in the 80s earlier in the year until pretty recently. It was trading in the 70s. So it's already endured a bear market. And so it could endure another bear market before you even break even. And now Citigroup's going to stay profitable, in my opinion. They pay 224 per share of an annual dividend. They're buying back some stock, so that will actually increase the book value per share. They have a big trading business, which is going to benefit from this volatility. They will be impacted by tariffs for sure because they have a big kind of international trade. So there's it's not all roses, but nothing that I don't think that they'll retain a reasonable profitability. So at it closed the last quarter with a book value right around 89, tangible book value that is. So at 45.10, which is our break even, the stock would be trading at about half of tangible book value. So tons of upside, very little risk, in my opinion, at that price and with this trade. So, folks, that concludes the presentation. I hope that you got something from it. And look, if you're stressed out, if you have additional money that you're looking to deploy, this is a time when there's phenomenal opportunities, but you need to know what you own and why you own it, or your advisor needs to. Like if you're sitting in cookie cutter mutual funds, there's no protection there. Sure, like over a 40-year period, you'll be fine, but we could be in the early innings of something more substantial, maybe a lost decade like we saw in 2000 to basically 2012. So, here's my contact info. You can reach out to me directly, tim@ttcapitalonline.com. Phone number is 805-886-8140. We just refreshed our website, www.ttvalueinvesting.com. You can get our newsletter there, sign up for it. You can get a link to my book I just wrote. You can get a link to our radio show episodes. And yes, we'd love to be able to help you. If you have a friend, feel free to refer. And just thanks so much for your time. Look, we're going to get through this. Our strategy is holding up really well. And now I think it's going to be time to play offense sooner than later here. So I'm excited about the opportunities that are presenting themselves. So thank you and have a good rest of your week.